The word recession gets people very emotional. It gets some people excited, it gets some people scared, and now it gets some people very politically charged. But what I want to do today is not talk about the emotions of a recession, but rather talk about the financials of a recession, that way you understand what's coming to our economy in 2023, into 2024 and beyond, because our economic craziness is not ending in 2023. Now, the first thing that I want to say is that recessions are a part of our economic cycle. Period. They have happened in the past and they will continue to happen. But do you want to know the longest period in our modern American history where we have gone without an economic slowdown, without any sort of recession? Think about it. It was before 2020. After the 2008 crash to 2020, February 2020, that was the longest period in modern American history that we have ever gone without seeing a downturn in our economy. 128 months. So before the 2020 pandemic hit, we were due for an economic slowdown. Well, then the pandemic hit, our economy was shut down, and we were forcibly put into an economic slowdown. We were forcibly put into a recession. Well, we were in a recession in 2020, but most people never really felt the real pain of a recession. I mean, we remember 2008, if you were old enough to remember 2008, that was real economic pain. People lost jobs. People had real financial struggles. Now in 2020, yeah, lots of people lost jobs, but the Federal Reserve Bank worked with the government to print a ton of money, more money than we've ever printed ever before. And then this money went out, and some people got this money in the form of stimulus checks. Some people got this money in the form of unemployment checks, and businesses got this money in the form of PPP loans. Other businesses got this money in the form of other corporate government loans. So lots of money was printed and sent out. And we were in a recession, but we were seeing booming sales. We were seeing booming sales at companies like Amazon. Walmart was seeing booming sales, and also luxury companies. Gucci, Louis Vuitton were breaking record sales when we were in a recession. So we were in a recession, but for the mass majority of people, they weren't feeling any pain of a recession. So we boosted our economy in 2020 and 2021 through the help of super low interest rates, through the help of extreme money printing to the max. And when I say extreme money printing to the max, when the 2008 crash happened and we were talking about $1 trillion stimulus plan, people were losing their minds. Well, we did multi-trillion-dollar stimulus plans after the 2020 pandemic, to put that into perspective. And to put it in even more perspective, who was now our Treasury Secretary, Janet Yellen, before the 2020 pandemic, she was our Federal Reserve chairperson. And what she said then was, when we had about $25 trillion, $20 to $25 trillion worth of national debt, she said that this amount of national debt should keep you awake at night, because of how dangerous our $20 to $25 trillion worth of national debt is. Well, then she moved to our Treasury Secretary, so away from the Federal Reserve Bank, into our government offices. And when we were around $29 trillion worth of national debt, she was asked the same question. And what she said then was, we don't have to worry about this high national debt because interest rates are so low. This is back in 2021 when interest rates were at rock bottom, the lowest we've ever seen. So essentially what she was saying is, we don't have to worry about these high levels of debt because we have such low interest rates, so our cost of servicing the debt is low. Well, now here we are today in 2022 going into 2023. Our national debt is more than $31 trillion, and our cost of servicing this debt is way higher than where it was in 2021. And it's way higher than where it was pre-pandemic because interest rates have gone up so much. So now the question is, what's coming ahead? And unfortunately, this has become a political question where, Democrats say this because they're in office and Republicans say this because they want the office. Look, this is a financial question. This is not a political question. And what we've seen happen in the past, historically, is the size of the bust is proportional to the size of the boom. When the 2008 crash happened, we had a huge real estate boom fed by lots of debt, fed by lots of adjustable rate mortgages, fed by a lot of greed on the side of banks, and also greed on the side of people, because it takes two people to tango. I mean, banks offered these loans without any education, but people also wanted homes that they couldn't afford. So you had two sides of greed, which then fueled this massive real estate bubble, which then burst, which caused a big fall. Same in 2020. We had a huge dot-com bubble boom where everybody thought dot-com companies were the savior to our economy, that dot-com companies couldn't fail, that dot-com companies were only going to go up. Well, eventually that bubble burst too. And now what we've seen is after the 2008 crash, we had that period from 2008 to 2013 or so where it was just recovery. But then from there, everything grew. Now, it wasn't a massive, huge, quick boom between 2013 and 2020, but it was a steady rise. But then after 2020, when we cut interest rates, we actually started cutting interest rates in 2019 because our economy started to slow in 2019. The fears of a recession started coming in 2019, but then the Fed started cutting interest rates in 2019 to stimulate the economy. Then came 2020, and then we cut interest rates to the lowest level ever. We started inflating our economy with more cheap and free dollars than ever before, and now we really created a boom. The biggest boom in really every asset class ever. We saw the stock market grow at the fastest rate ever in 2020. We saw our real estate market grow at near, if not at record speeds. We have seen bond markets grow, so much money flow into bond markets than ever before. This is why a lot of people called it an everything bubble, because we saw everything grow so significantly. Now the problem is the Federal Reserve Bank, who is the entity in charge of our monetary supply, they're the entity in charge of our money, they're looking at this saying, oh no, we printed way too much money. And the side effect of printing too much money is inflation. Well, we have a lot of inflation. Yeah, it's come down off of its highs, but inflation is still significantly higher than where it should be, according to the Fed. So we have extremely high inflation, and now to combat this inflation, you have to do the opposite of what caused the inflation. What is that? Well, now instead of cutting interest rates, we're raising interest rates. Instead of fueling our economy with cheap dollars, we have to pull these dollars out of our economy. All of these things have economic consequences, not to mention the economic consequences of high inflation. Now, there's still a lot of excess dollars floating around. People still have excess dollars from the pandemic. Governments, businesses still have excess dollars from the pandemic. But that will eventually go away. When will it go away? Well, the prediction, according to a lot of economists and banks, is towards the end of 2023. Now, if that is true, if people run out of their excess dollars towards the end of 2023, while inflation doesn't completely go away, because it doesn't look like inflation is going to come down to 2% in 2023, although a lot of people say that it will, it doesn't look like that's going to be happening. That means we have high inflation, which disproportionately hurts the financially uneducated and the poor, because inflation is a hidden tax, and it taxes people who don't understand what inflation is, and the average person has no idea what inflation is. This is why financial education is so important. So the average person has no idea what inflation is. Inflation continues to happen, which makes your salary less strong. It gives you less buying power from your savings. It gives you less buying power from your paycheck. While people's savings are going down, while credit card debt is rising. Right before I recorded this video, I got a new report which said that our third quarter credit card debt rose in 2022 at the fastest rate ever. What does that mean? People are spending money, which is good for the economy, but it's not good for people. Because how are people spending money? Well, they're spending money because their credit cards are still allowing them to spend. And this isn't a problem. Debt isn't a problem until it becomes a problem. So you can have as much debt as you want. You can be underwater in your home. You can be underwater in your car, and it doesn't matter. None of these things affect anything until you struggle to make your payments. Now, if you have a fixed rate debt and you're underwater in your home, it doesn't matter. It would matter now if you no longer have the ability to make your payments. What would cause this inability for you to make your payments? Well, it's going to be some sort of economic pain to you if you lose your income or if your payments go up. So on the idea of credit card debt, if interest rates continue to go up, which it looks like they're going to continue to go up, well, your credit card debt is going to become more expensive because your credit card debt is not a fixed rate debt. It's a variable interest rate debt. So as interest rates go up, your payments on your credit card also go up. And when it comes to your other fixed rate debts, well, now it's not an expense issue because if you have a fixed rate mortgage, well, the cost on your mortgage isn't rising. But if your income goes down because you lost your job, you got laid off, something happens to the economy, well, now you struggle to now being able to make your payments. That is when debt becomes a problem. Debt becomes a problem when people lose the ability to pay. And right now, debt isn't a problem. We have more debt than ever before. I've made multiple videos talking about this. So if you haven't seen those, go check out some of my videos on loan defaults and the excess amount of debt. But we have the highest amount of debt ever. We have the highest amount of national debt ever. We have the highest amount of corporate debt ever. And we have the highest amount of household debt ever. Again, it's not a problem right now because households still have the ability to pay. Yeah, we've seen a little bit of a rise in mortgage delinquencies and a little bit of a rise in auto loan delinquencies, but people still have the ability to pay. Corporations still generally have the ability to pay, although yeah, some corporations are struggling. We've seen Carvana, Bed Bath & Beyond, and some other corporations start to struggle. But for the most part, corporations are still doing okay, and our government is still doing okay. However, remember what I've been saying, debt isn't a problem until it becomes a problem. What will make it a problem? When people lose the ability to pay. When will that happen? Well, either if inflation catches up, or second, if people lose out on their excess cash, their ability to spend, or third, if they lose their income. So you have to pay attention to what's going on in the economy. You have to pay attention to what's going on in terms of inflation, and you have to pay attention to what's going on in terms of jobs. Now, I don't say this to make anyone freak out or make you scared, but rather so you understand the economics of how economic cycles work. Because economic cycles, I mean, you have booms and bust cycles. This has been happening forever now, but we never grow up learning any basics of economics. And then what happens is we become the subservient pawns when the economic cycles happen. We know through history, economic cycles happen, but most of us are never prepared. And when you're not prepared for an economic cycle, not only can you not capitalize on opportunities that come your way, because recessions create more opportunities and more millionaires than any other time, but you struggle to just be able to survive. You can't worry about capitalizing on opportunities if you're worried about surviving. Now, is there a chance that we could bypass this entire recession? Sure, there's a chance. But there's no harm in you preparing and being educated and taking care of yourself. Because if you are prepared, if you have cash put aside to protect you and you have cash put aside to take advantage of opportunities, well, then you just have the ability to take care of yourself. And if nothing bad happens, you can just go to Disney World. You can go out and buy yourself a nice car. You can do whatever else you want with it. But if something bad does happen, well, now you at least have the ability to take care of yourself and capitalize on opportunities. And the next thing that happens is people get worried and they think, well, it hasn't happened yet, so where is it? We become impatient because we expect these types of economic slowdowns to happen instantaneously, but we're watching it happen in real time. And this is where, I mean, if we look back to history, the 2008 crash didn't happen in 2008. We had a huge buildup from after the 2000 dot-com bubble bursting, interest rates going lower, which then fueled people going out and getting mortgages and buying homes they couldn't afford, to then in the middle to early part of the 2000s, to the growth of adjustable rate mortgages. And then around 2005 and 2006, that was when interest rates started to really affect home prices. And around 2005, 2006, home prices started to fall. That was when the bubble started to burst. 2007, they fell even more. The bubble was bursting more. But nobody talks about 2006. No one talks about 2007. What do they talk about? 2008. 2008 was when the bubble really burst. But that wasn't the bottom for the housing market. The housing market continued to fall into 2009, into 2010, into 2011, and into 2012. 2012 was when the housing market bottomed. So you're talking about almost 7 years of a bubble bursting. And this is where you can't expect these types of events to happen overnight. And being prepared is not something you do for tomorrow. Being prepared is a lifestyle that you live, where you understand what's happening. You work on your income. How do you keep a stable income? How do you grow your income? You work on your spending habits. How do you live below your means? And then you work on your investing habits. If you have a passive investing strategy, like a dollar cost averaging strategy into the stock market, you don't change that. If you're worried about a recession or market crash, you don't change that. You keep doing the strategy no matter what, whether the market's up, whether the market's down. This strategy never changes. But if you're looking for active strategies, where you're looking for real estate deals, stock market deals, you're looking to invest into startups, now you have to just make sure that you're buying something that has true value, and you're buying something that you believe is a good value. And this is where being picky becomes important. Now, it doesn't mean you shouldn't invest your money. It means just understanding the opportunities. And this is where a lot of people are predicting, this is what's going to happen in 2023. It's impossible to predict what's going to happen in 2023. But what we can see is that the Federal Reserve Bank is working to increase interest rates. Well, there's a delayed effect to increase interest rates. And when you increase interest rates, you're going to see the effect of the higher interest rates over the course of 6 to 12 months. Well, when the Fed started increasing interest rates, we are starting to feel the effects of that now. But as they raise interest rates, we continue to raise interest rates even higher. So you have to understand that there's going to be effects of the higher interest rates, and we have yet to feel the effects of them. Yeah, there's some industries that are more sensitive than others. Real estate is a more sensitive industry than others because as soon as interest rates go up, housing affordability goes down because now you have to pay more money to borrow the same amount of dollars. But understanding now, there's going to be a lot of blame. This is the last thing that I want to talk about, is there's going to be a lot of blame. People are going to blame everybody for economic pain. And this is where I want you to understand now, what is the cause and what is the effect? If the cause of the inflation is the Federal Reserve Bank, because inflation comes from the word inflate. What do you inflate when you have inflation? You're inflating the monetary supply. When you increase the monetary supply, you increase the amount of dollars out there, you increase demand. Because now if you give everybody thousands of dollars, people are going to want to go out and spend this money. It's human nature. We've seen this happen time and time again. When you send out a stimulus check, the goal is not to stimulate people, it's to stimulate the economy. How do you stimulate the economy? You give people money so they have money to spend. So when people have money, they go out to Amazon, they go out to Walmart, they go out to Target, they go out to Lululemon, they go out to Apple, and they spend. Now this stimulates the economy. Well, what does that do? Well, if you're creating more demand, you also need more supply to make up for this higher demand. Because if people are buying things at Walmart and Apple have to continue producing in order to meet this higher demand. The problem in 2020 was there was no ability to produce that supply because everything was shut down. Factories were shut down. Businesses were shut down. So that then created supply chain issues. Now you had people pointing fingers. No, it's not the Federal Reserve Bank. It's not the stimulus. It's not the money printing. It's the supply chain issues that are causing inflation. And they're saying, no, it's the greedy corporations for causing inflation. However, you're missing the root cause. The root cause is the inflation. If we didn't have the inflation, you wouldn't have that excess demand. Without the excess demand, you wouldn't have the supply chain issues. So you create this domino effect, but you have to look at the beginning. So now if the Federal Reserve Bank was the entity that then created the inflation, and now they're the entity that's working to bring the inflation down, what is going to be the cause of economic pain? Well, if there's an entity that's now working to correct the mistakes that they made in the first place, the pain that we feel in order to correct the mistakes are going to be from the Federal Reserve Bank working to raise interest rates. Now, unfortunately, fighting inflation is extremely important, and it's more important than preventing a recession. And this is one of those things that creates a lot of controversy. We can't have a recession. We can't have job losses. Well, from an economics factor, Recessions are a part of our economic cycle. The reason why is because you have to have the booms and the busts. They correct themselves. A bust is what corrects a boom. It's what creates the refresh in the economy. It's what gets the bad investments out of the economy. It's what gets the bad companies out of the economy. It's what gets the bad things out of the economy. You have to have that refresh. You can't always just have a boom, because you can't always have just dumb money, dumb investments floating around. People lose money. It is a part of investing. Investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you should never blindly listen to or trust a random guy on YouTube. But this is where understanding that you have to have these types of busts in order to correct some of the booms. And what's been happening in the recent years is we have been actively trying to avoid any sort of economic pain. Well, that has its own consequences, because then that makes the bubble bigger. And eventually a bubble will have to burst. And when a bubble bursts, that's when people feel the pain. And now we're facing the issue of an economic pain with an issue of inflationary pain. Well, inflationary pain is much harder to correct than economic pain. Economic pain has happened, but inflationary pain is where now you're facing issues of a currency crisis. You're facing issues of the value of your dollar going down. And that has way more implications, way more negative impacts than a recession. Recessions are a part of the economy. And this is where now the Federal Reserve Bank is going to be making a choice going into 2023. Do we want to create a bigger boom, or do we want to save the health of our dollar and inflation? And of course, now this then gets into all the geopolitical issues. You have the BRICS nations that are working to create their own currency, trying to divest away from the dollar. The BRICS nations are Brazil, Russia, India, China, and South Africa. They're working to create their own currency. You have the issues with the war, Russia attacking Ukraine, and the risks of that potentially expanding. And this Ray Dalio talks about this a lot. But the United States is the world's superpower right now. And there's many countries like China that want to challenge the United States. And when is a good time to challenge the United States? When a country is weak. When is a country weak? When they're working, fighting their own internal issues, when they're economically weak. And so this is where understanding, there's all these different things happening. Hopefully it all blows over. But the whole point of financial education is to be prepared for anything. Prepare for the worst and hope for the best. We talk about this all the time in life, but how come we don't talk about this in economic terms? People get so emotionally charged when anyone says prepare for the worst. And this is where, what do? Spend less, earn more, and invest like crazy. Have cash put aside to protect you against a financial emergency, and have cash to take care of opportunities that might come your way. If nothing happens, well, you just have a big bank balance. You're welcome. If something bad does happen, well, now you have a bank balance to fall back on and take advantage of opportunities. So this is where understanding, not freaking out, not panicking, but understanding the way the economy works, that way you take better care of yourself, you can take better care of your family, and better care of a community. And when I was getting started a decade ago, I didn't have that much money to start investing in real estate. There's no way that I'd be able to do today what I could have done 10 years ago. And this is where now, instead of just trying to copy what somebody else did, you have to be able to find the opportunities around you today. So what does that mean exactly? Well, when it comes to buying assets, it just means looking at the different opportunities. You